Hello everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predict gold prices. In my last video I said that you should buy lithium instead of gold, and lithium has done very well. It's just kept rising and rising, and it has never gone down, while gold is just doing nothing. You can see here, 1 month has done nothing. Okay, so let's see where we stand now. Is gold going to go up or not? And for that, we look at the gold forecaster index, which is based on leading indicators. So the Fred website has actually deleted the gold price, but we can use the producer price index for gold ores. It's almost the same. So that's what I used. So the latest data point says that gold will be higher. So we are still above the zero line. So I expect that gold is now bottoming out and will go higher. February, March is seasonally not that strong, but I see an improvement here in the gold forecast index. Also, this is very bullish. The Taylor roll rate has gone higher. It's shooting higher. It's now almost at 10%. So that means that the Fed funds rate needs to be at 10% right now to tame inflation. And where is the Fed funds rate right now? At 0. So if you look at this, whenever we see a spike in the Taylor roll rate, then gold is going to move higher. Whenever it is negative, like here, then gold goes down. So this is a huge spike, and the Fed is not going to raise rates to 10%. So I think that gold will start to bottom out and go higher based on the Taylor roll rate. Misery index is slowly moving higher, so more unemployment and more inflation. So gold will also move higher. So let's take a look at the real output. Okay, so real output improved, but it's still very unproductive. So CPI might move higher. Let's take a look at production in Chile and Peru. Production is higher in Chile and Peru is down a bit, but they will start increasing next year, probably. So that's a lot of supply is going to come online for, especially for silver byproduct. So I would be more buying gold than silver at this moment. GLD, that's still the latest data, hasn't moved a lot. Here also no real institutional buying yet. Latest data on China. There's healthy gold demand. You can see that the trend is up. But look at the silver demand. Silver demand crashed in China. So Chinese like gold more than silver. So you better just do what they do, buy gold instead of silver. Here, a little tick higher, but nothing special. So China was on holiday, so we don't have a lot of data from China. Here, nothing special. We need to see this go lower before we become bullish on silver. US mint sales were very good. So you see gold and silver sales at the US mint have shot up. So that's a good sign. Premiums have not done a lot. They are stable. PSLV premiums went up. So I think interest is coming back into the silver space. Here you can see there's a small tick up, but it needs to go to 0. It's still negative right now. COT reports were positive, so the shortest have diminished a bit for gold and also for silver. So if there is a time to buy gold and silver, it's probably now. Also here, COT report is very positive. So this is typically a bottom in silver. The same here, a bottom in gold. So I think it's a very good time to get in and accumulate. Swiss franc still going down. We need to see that improve. Tips aren't doing that well. So that could be a bit bearish. So we have some good news and some bad news for gold. But overall, I think we will go higher. Real yields still very negative. Seasonally, we are not that good right now, but you can start buying the dips, I think. The gold miner sentiment is stable, so we are not at the high levels yet, so it's a good time to get in. And currency in circulation is higher, but not growing that fast. So let's take a look at the central bank balance sheet. So the Fed is starting to taper normally. As you can see here, the slope is flattening. So they are tapering, and probably will hike rates soon, starting in after March. Here you can also see that they are increasing the cash in the treasury, and they will issue a lot more debt. That's also why the yields are rising. So let's go over the deficit. Still a lot of budget deficits. The goods deficit is hitting new highs here. Services are doing better, but the goods deficit is rising. You can see that here. And there's still this gap between import and export prices. So that's bad for the dollar. Capacity utilization is stable, is at 76.5. I had hoped to see it go higher, but it's now stabilizing. So manufacturing is not doing that well. Still, I think inflation will go up. Money supply. Money supply is rising, but at a smaller pace, but it's still rising. So we're still in inflation. So we need to stay in inflationary assets. Here I wanted to show that the market is expecting a rate hike. Believe it or not, the 2-year yield is spiking. And that means that the Fed will need to raise rates. You can say all they want, but the Fed typically follows the market. And they need to raise soon, because if they don't, there will be a lot of inflation. So I guess that we need to protect ourselves against inflation. And here you can also see the other yields. And look at how fast it is rising. This is normal, a slope. But look at, this is almost exponential what's happening here. So the 2-year yield is almost the same as the 5-year, the 10-year, 30-year. So at some point, they will cross each other, and then we will have an inverted yield curve. But the pace at which this is rising tells me that there is a lot of inflation. A lot of inflation coming. Because they are fleeing the bond market. And this only happens when we have a lot of inflation. Here you can see the yield curve. So the yield curve is starting to invert, but we're not there yet. So we still have about a year until we go into the recession here. So I would stay in stocks and wait for the yield curve to invert. Stay in inflationary stocks. This tells me a bit that yields might top out. So we will see. We need to take a close look at the 10-year yield. So I wanted to talk a bit about balance of payments. So as you know, the current account is in massive deficit in the US. Trade deficits are rising, current account deficits are rising. So in order to balance this, you need to have a positive financial account. So you need to have investments in stocks, bonds, savings to offset this current account. If that doesn't happen, then the dollar will fall. Okay, so here current account is in deficit, but capital account is rising. The stock market is rising, bonds were rising, but lately this here is going down. You can see the Nasdaq going down. You can also see the bonds going out. Bonds outflows are rising. So at some point, when you have negative current account and negative capital account, then the dollar will start dropping. So when this happens, what do you need to do? You need to start getting in commodities, okay, and emerging market assets. So that's what we are going to do. We're going to protect ourselves against this inflationary wave. So Yardeni also lowered his forecast on the S&P. So it was like this: 4,800, 5,200, 5,500. And now the 4,800 has been extended, and then we have almost the same price here. So basically, Yardeni is thinking that this year will be nothing. We won't go higher. It will be a flat year. So why stay in stocks, right? So this is telling me that there is stagflation. And stocks are not rising, but inflation will. So that's why we need to be in gold, because gold is a stagflationary asset. Another interesting chart, this is the container shipping rate. It's making new highs. So this tells me there's a lot of supply chain issues still, and that will lead to more inflation. So A lot of inflation coming. This was an interesting chart. So apparently palm oil is a leading indicator for crude oil. So if you want to play the crude oil market, watch palm oil because this always goes first and then oil follows. You can see here the tops, bottoms, tops, bottoms. So watch palm oil because they use palm oil for diesel. And when this goes too high, then they can't use the palm oil for diesel. And then there will be a diesel shortage. And that's why palm oil is leading crude oil. So if you want to play this, watch this indicator. Another inflationary asset, cobalt, is going in deficit. Deficits until next year. So that's very good to have in your portfolio. For example, Capstone Mining has cobalt. Some other metals here, aluminum, zinc, copper, all very good metals to invest in. And you can see here, China is doing the absolute opposite of USA. China balance of trade hitting new record highs, while the USA is hitting new record lows. So China is winning here. And all the money that they have is going to go into commodities. So you can see here in the past that China, there were a lot of tourists, service trade balance was negative, but that has now come back to positive. So that explains why there's such a high balance of trade. And I have talked about this for years. With this money, China is going to buy commodities. And I wanted to talk about one commodity that I think is going to go higher. I'm not sure yet, but I think the probability is very high. So let's talk a bit about natural gas. So you can see there's a huge discrepancy between Europe, Asia gas, and US gas. So we are here about around 6, 7, and EU gas is here around 25, so that's 5 times higher. So you could argue that US gas is going to double at least to meet this EU gas when you look at the history. And I don't think that EU gas is going to come down that fast. We have Russia problems. We have China trying to gobble up all the natural gas. As you can see here, natural gas demand from Asia for LNG is only going to increase. Demand is going to increase. Supply is stable. So that means that natural gas is going to keep on rising, right? And it's not coming from the EU. And yeah, natural gas will be coming from USA. So you can bet that US natural gas will go up. Now, what does this mean? If natural gas starts rising, then another commodity will rise. So here you can see the natural gas costs, and you can see that the price of, for example, ammonium nitrate, these are raw materials for fertilizer. You can see that they are below the cost of production, some of them. So they cannot create ammonia profitably. in Europe. So yeah, if natural gas keeps on rising, then fertilizer prices will be rising. We also have tensions in Belarus. Russia is occupying Belarus, and they have sanctions Belarus. So that's 15% of global potash. Then we have Lithuania, which is disrupting the supply chains with Belarus, and also the Russia sanctions that will be coming. So we have 50% of global potash there, and it's being disrupted right now. They have Russia, for example, has banned exports of some fertilizer material. China has banned export as well. So I think that agricultural commodities are going to keep on rising. And yeah, this trend is broken to the upside. I expect more upside to come. Here as well, ammonia has been rising. And that's because ammonia is correlated to natural gas. And if you look good here, you can see that natural gas spikes first, and then ammonia follows. So natural gas is actually a leading indicator for the fertilizer. So watch natural gas prices, because that will tell you if fertilizers will go up or down. And that will give you 1 month head start to either buy more or sell your fertilizer stocks. Here, Russia has a ban on ammonium nitrates, and China has a ban on phosphate fertilizers up until June and April. So if you are in fertilizers, I think you will be safe for the first half of this year. In the second half, we will need to reassess, but I think we are sitting pretty well on fertilizers. So that was the update. Need to get into this sector. And I'll see you in the next video.